Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome Francis Hunt to the program, a trader and technical analyst with 30 years of experience and the creator of the Hunt Volatility Funnel Trading Method. We're going to discuss the China-US trade war erupting and how it will affect financial markets and the economy as the Trump administration picked a fight they cannot win. We're going to talk about gold and why Francis thinks we're on the brink of a massive monetary reset that will see the metal skyrocket to prices most investors can't even imagine. We're going to get his view on silver and why it might not be time for the silver bull to run just yet, and so much more. I hope you'll enjoy today's conversation with Francis Hunt. Francis Hunt, it is great to have you back on Commodity Culture. I want to start by discussing the full-on trade war that appears to be developing between the US and China after the whole Liberation Day fiasco and Trump's tariff U-turn basically left China alone in America's crosshairs. I'm wondering if you think this is a war that the US can win, and what are the long-term implications for the global economy and financial markets?
First part first. Short answer, no, you don't win it. The US does not win that war. In terms of my take on it, it is essentially, my paraphrasing is a hard partying bodybuilder that's taken steroids and got late in years, and he's in the pub at 55 and he's a bit drunk and his liver's in a poor shape. But he was a big, strong-ass guy, and he bullied a bunch of people and flipped a couple of nations over, which means probably throwing people around inside the pub on the evenings while working out in the gym during the day. Now feeling like the degree of respect for him and the enemies is reducing, and he's out there and he's a little bit tipsy and he's saying any comers, and threatening people in the pub. And there's a Chinese guy at the bar, and he's not reacting in any way. He's just standing and observing, and he's going, "Hey, you yellow man, you got anything you want to say about this?" And he's just sitting quietly and watching because he doesn't need to get an assault rap and take him on. The guy's probably going to do damage to himself all by himself. The Chinese have a saying that says, wait long enough by the riverbanks and all your enemies will wash by. You don't need to be the one to get in a brawl and get an assault charge. He's probably going to break his pelvis stumbling out of the pub. That's kind of the caricature I'd give. By the way, that's not my take on the average American citizen. I love the Americans. I love visiting there. They're cool people. I get on real well with them. This is just the conduct of what I almost refer to as the parasitic control mechanism that has America by the throat. And this is how they've been conducting myself. And the caricature I just described is very much towards them and that conduct. And it is a controlled demolition. In other words, it was always the intention to take bad stuff, get toxic, be a big tough man for a while, and then you burn your wick out. And that's kind of what's happened. They didn't think about longevity. They lent on bullying too much, and now they don't have the power they once had. A debt-based collapse started in 2020, in the late 2020, when we gave the call, this is peak bonds, and this is a sell-off. And the key thing, as we were talking just before starting, is that this is not 1987 where Greenspan can cut the rates and reflate. It's not 2000 where dot-com boom, you can super cut rates and reflate. It's not 2008 and 9 where you can cut rates and then do QE 1, 2, 3, grind along the bottom for quite a long time, but eventually create enough heat with proliferation that you manufacture some kind of recovery. It's also not 2020, where you then threw trillions, as never mind cut rates, which was peak bonds, the blow off technically in rates, in valuations, and the capitulation in rates right down to 0.33, where you threw everything, including 7 trillion into this. You don't have that option anymore. The bond market turned. That call is good. Nobody wants it as a reserve asset. What everyone needs to understand, the USD comes with a UST. It's borrowed into existence. You should think of them as a pair. Gold doesn't have a pair. It has no associated liability. But what you're seeing is home brokers are not wanting to originate new home loans. A, they're charging more in spite of the interest rates actually being at somewhat lower. And B, they're refusing 43% of loans. Why aren't they wanting to originate debt? Because somebody else has to buy that as an asset and there's no longer the demand for it. Or they have to sit with it on their own book and say, how good is that asset, the home market, given that we're in a hypervalued property market, hypervalued stock market, and we're in a collapsing bond market. And now add into all of that, there's 9 trillion in rollovers to be done, which simply can't be ignored. I have to mention it every single time. So anybody who thinks you're going to get QE, hold on, you've got this 9 trillion to find a home for. Otherwise, you've got to pay all of it off, which nobody can do, not America, not anyone else. So you have to put it out again, and it's going to be put out at much higher rates, even if we have a rate cut or two in the next few months. So your interest bill's going up. Right now, your boomer demographic, which is like an inverted pyramid, welfare, Medicaid, and Medicare are all going up. Everything's going up. The unfunded, those were the primary unfunded liabilities, which many have estimated actuarially could be 600 trillion. And it is part of the reason why I think we had CV19 and the first people were the elderly to be, let's just say, retired early. And it's part of it is the pension problem in European, particularly white European nations, which seems also to be the worst hit. And the design thereof was very specific ethnically as well. Don't go down that rabbit hole too far on YouTube, but it's fair to say that we passed peak America, and that is unfortunately a factor of the abuse of the base layer of borrowing money into existence. Everything else, stock markets and their valuations, all sit on top of that. You first have to have a point system, which is money and debt. That is the foundational layer. You've borrowed too much. So in terms of how I say, how do you become rich? I say, well, Jesse, here's what you need to do. You live within your means. You earn more than you spend. You basically produce more than you consume. Another way of saying the same thing. You invest smartly with the surplus, such as buying gold in this time. Not every time. I'm a massive gold bug now. I'm not always. There will come a time where I will trade gold for other assets. And that's how you get wealthy. That's what China is doing. They produce more than they consume. They have trade surpluses with the world. Everybody gave up manufacturing because they could get slave labor wages out east in many of the countries there and live the life of Riley and say, hey, put it on my credit card. We don't have a black Amex with a bottomless limit anymore. America's had its overdraft. Its bottomless overdraft changed. Here's the limit. You got a limit here now. Now suddenly you've got to make hard decisions. Things have to go down. So everybody who's been saying there's a melt up still to come, they're living in this 1987. We're just going to keep ad-libbing the cycle. You just keep adding, bigger amounts in each QE, cutting the rates, bigger pump, etc. No, because the system that allowed that now is broken. That allowed you to put out the fires is broken. You have no functioning fire engine. You have no water. The fire burns right the way through all this dry undergrowth that should have been cleared many times before and many opportunities before. So that's my take on tariffs. That's actually the theater of, and it's being, personalized Donald Trump's breaking America or Donald Trump saving America, depending which side you're on, left, right. I have no side in that argument. They're both awful. But the key part of it is he's going to be blamed. Tariffs are going to be blamed. You'll be this fall guy, this actor, whatever the case may be. The point of the matter is America got to this position through multiple decisions and ongoing negligence, all the way from when they used to be a producer nation that produced more than they consumed. After World War, when everyone else was on their knees, America made stuff for everybody else. And since then, it's been going down, and then they pivoted it into a creditor nation where they were spending more than they consumed. And then you got the Vietnam War, which caused the first such crisis. But you got the right guy in the Fed chair, and he turned up the pain so hard that you had a decade and a half of stagflation. And he fixed that, and he reset the debt at immense pain of growth and many other things. And since then, Greenspan that economic criminal that should be in The Hague for crimes against the world in terms of economic policy, and everyone who followed him. So Greenspan, Bernanke, Shlomo Bernanke, our friend, Yellen, and now ending probably with Jay Powell, all the way through. All these guys continue to play the same book that they were given by Greenspan, because he'd set the tone, and you get more and more cornered in, you'd have less and less optionality. And now Trump has zero optionality, and Jay Powell in this situation, in truth, has very close to zero optionality. People think the Fed sets rates. They're wrong. The Fed can suggest a rate setting. The market needs to agree. That's why they start signaling it, so that the market starts buying bonds to make that easy profit by the time they announce a rate cut. Rates down, bond values up. But who's going to come rushing in to buy bonds? If the Fed says, we're going to cut rates, we need it, it's a recession, that everybody's struggling, who's going to come in and buy the bonds? You need massive flows out of equities into bonds, but the flows out of equities going into gold, because the reserve asset is no longer respected, because it lost 50% in 4 years from the back end of 2020 to its low recently. So it's no longer a stabilizer asset. It's too volatile, and it never gave alpha like the equity markets. It gave very low return. It was there for stability in a portfolio and a bit of counter trend when equities crashed. It got a bit more of a bid and went slightly up. You didn't have as big a loss in the bad years, but it never gave you the 35% of the big bull markets in the good years. Never got close. So it ceased. The 60-40 portfolio is a busted flush on account of debt. Actually will pay you insufficient yields right now, and is more likely to go chronically down in capital value. Who wants an asset like that when you have an inflation that's going to be stubbornly high, and you've got a benefit of globalization that's led to ever lower costs? So we never saw the inflation. The inflation went into assets. So we got hypervalued housing, hypervalued stock markets. We're still kind of there, even though we've corrected. Tesla's sitting on a 91 PE, by the way. That's insane. It's still 90 plus of its revenue is still cars. It's all this fluff about Mars and taxi companies that are without drivers and making gazillions and pricing in all these future profits. None of that's come. He's got a Cybertruck. It's a lemon. Can't be sold in the EU. Weighs over 3.5 tons. Where is Tesla Q in the shorts now? If they'd been patient enough, this is the key moment. Recession with the possibility that rates might rise. Why? Because you've got to find a home for 9 trillion. Who's going to buy that? Pension funds can't afford to buy it. So you're not paying enough, and we won't be able to make our pension payments. We have to buy it for less and get paid more. Then it might work. In other words, rates need to rise. This is what's happening. People don't understand the plumbing of the debt market is the funding of pensions and everything else. So pensions are destroyed, record bankruptcies at the moment, record declines on auto loans at 36%. I've already mentioned 42%. This is the great collapse. This is reset, and it's going to have rolling contagion. And I wouldn't be shocked if they also threw some geopolitical events. But financially, this is reset, and it's going to start involving hedge funds and it's banks. This is what hasn't been mentioned yet. And watch for the carry trade unwind. It's never unwound. It's never unwound. You've had a little shock, and then, oops, we stopped that bus. We can't let that one play out. You're now seeing the Bank of Japan's rates going up. So people that borrowed in yen because it was cheap bought dollars on the USD JPY, pushing the dollar up, suppressing the yen, then went and invested in Mag 7 and or treasuries, which were paying a higher yield. Suddenly find themselves, the treasuries collapsed immensely in value, mainly in the US, particularly. Japan has still kept their value. And at the same time, the dollar's gone down. The dollar went down in value. So dollars went down in value, and your USD JPY is actually in a head and shoulder and is a fear indicator and is collapsing. So you actually need more dollars to pay back the borrowings now if dollar is going to go down. And at the same time, the asset you bought is no longer capitally appreciating or paying you the yield that you want. So the yield differentials are squaring. There's probably a bank in between there that took a margin. It's actually no longer a good trade if you do it. So what you do, you sell the treasury. So we had a head and shoulders on the USD JPY. We can bring that up. Not the USD JPY that I want to refer to, the 10-year debt instrument. And that started to break down because the economy was weak, and that's typically what happens. Rates want to go down in a weak economy, and then suddenly, boom, everybody in sheer fear, you spiked right the way up. In other words, you got the seesaw where rates go up and bond values go down. Suddenly the seesaw just broke. They don't want either. So you actually had the relationship that the dollar was being sold and the treasury was being sold. And normally you get currency appreciation when your rates go higher. So you actually had a break in the seesaw. And that I warned when this happened to Britain during the pension crisis of trust. America will have this moment. It will come. It's a microcosm, what happened in the UK, and it will come to America. You had your first flash of that, where both sides of the normal relations that is actually inverse went the same way. Bonds down, dollar down. And that's a sign of Americans potentially, because they blamed it first on China. Then they said, no, we think it's Japan. That's a lie, because after the World War II, America kind of controls the economic policy in Japan. Yes, that sounds shocking. Listen to our Professor Werner interview on Princes of the Yen in terms of how everything is done there. So they are almost a proxy, which is why they're also 1.1 trillion holders, bag holders for the collapse. They probably wish they didn't have that, but they probably had no choice. So when people have to sell treasury, send the money back to buy, the yen strengthens and the rates are going higher, because their debt isn't being looked favorably on locally by Japanese people. They're going to start buying gold, and the Japanese wives used to take the salary checks from the Japanese husbands, and they used to buy the bonds and do conservative things. Now, already the government owns a lot of the bonds and a lot of the markets. The stock market, they don't want either. They don't want their stock market. They don't want the bonds. They want preservation of capital. They're also an aging economy, even further demographically like this. So they're buying gold to preserve capital too. They're seeing what China is doing. So this is the whole play out. This isn't 87, 99, 2008, 2020. This is reset. This is the big one. This is it. And we're going to have multiple crises coming back to back, and it's just started. And all those guys that are in the melt-up camp, where does the money come from that's going to drive the bid stack, buy up everything that's overhanging on the upside? Dimon is selling stock again. All the insiders are buying stock. Oh, it's only retail that's buying the dip, that have been trained multiple collapses to do that, just for this one moment where they'll destroy themselves. And you keep ponzing, you keep going double on black, double on black, double on black, or red, or whichever it is in roulette. And you only need to lose once, and you lose it all. And that's kind of where we're at. I fear for the Western nations, and I'm glad not to be domiciled in any Western nation. And I encourage others to think of that as a concept. But that's your 10-year treasury, and this is what the rates went up, and this is what your dollar did. Dixie. Smashed down. And it's actually below 100. Now, don't get me wrong, this is volatility, and the dollar can actually have a super spike eventually, potentially, on a debt-based correction again. We've had actually quite a long-term period of relative low volatility in FX, relative, on the monthly charts. We could see a major change in that too. So increased volatility on FX as debt markets. Remember, debt and currency are tied together. Debt and currency. You borrow a money into existence. Just like if you say gold, what's its price? It's XAU USD. What are you comparing it? And the buy gold trade is a sell dollar trade. And that's what I would leave you with and let you unpack some of that.
Hey guys, just a quick break to hear from our sponsor, ARC, silver, gold, osmium, for all your precious metals needs. ARC SGO is the place to go. Owner Ian Everard is trusted and given praise even by his competitors for being one of the most honest and informative gold, silver brokers in the United States. And their special is Silver Kangaroos 2023 1-ounce coins, mint fresh for $2.47 over spot, while supplies last. Take advantage of the offer by giving him a call at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Yeah, fantastic breakdown there. I had Darius Dale on the show a couple days ago, and he echoed your sentiments regarding that the Fed may be forced to actually hike rates in a recession to attract capital into the long-term treasury market, because, like you said, who wants to go there at this point? So some very interesting observations. Now, in addition to, starting a trade war with China, the Trump administration also very at odds with the EU leadership, particularly on the war in Ukraine and concerns, at least who knows if they're real concerns or not, but supposed concerns about the EU's continued descent into an authoritarian state due to their destruction of free speech. We saw that conversation kick off with JD Vance lecturing EU members and then a subsequent backlash from the EU. How do you see that situation playing out? And are the US really the good guys here, or do they have an agenda that most people aren't paying attention to when it comes to kind of this conflict with the EU?
So all this bully boy and Vance being rude in Europe and Trump being dismissive of the EU, which is part of what your question is about, and other action, including that involving China, which you also have just asked about, and the talk about Greenland and Denmark and Canada as 51st state. All of this blarney, I call it. It's kind of the Irish word for shooting the breeze in the pub and talking a bit of BS. Is all part of testing the water to try see where there's any low-hanging fruit. Why are they suddenly in scavenge mode and throwing their weight around? Again, I take you back to the core principle: the debt market broke. They can't afford what they're already doing, and now they need a retreat out of the de facto defense cost of protecting Europe, which America has over contributed on. Europe should have been protecting itself, but they said Germany couldn't have weapons after World War II. They wanted to cut their testicles off entirely. So, my father was a glider pilot. He flew with ex-Messerschmitt pilots in South Africa in the mountains as gliders. They weren't allowed to power planes. So that's why they're in sailplane gliding, for many, many years. So, you did that to a nation that has no defense, and you put American soldiers in Germany. Again, I refer people to our Prof. Werner chat. Germany never even got a peace agreement. It's still an occupied country with American soldiers in it. There was never a signed peace. It was in Japan. They signed it on the battleship. You might remember it, in complete humility. And they got a representative to be there to sound that. So there's interesting differences in all of this. Suddenly now EU now needs to military spend. They broke the likes of Credit Suisse that's been absorbed by UBS. By buying big buyers. The Swiss and the German banks, Deutsche Bank, Commerzbank, were big buyers of the subprime debt. They've never re-rated or cleaned that up. That's why they're broken balance sheets. They're being held up as proxy of state. So the EU has a broken banking system with major players that can't be allowed to fail because they are providing the banking services in Europe for now, until we have such an all fall down that we set the clocks back and we have whole new system, which is why the CBDC and the digital euro is due to come out in October. They're already wanting to get the parallel system running and up and start migrating people so that they can let the all fall down. So the EU is in a terrible state and now has to spend on investment. And in fact, whilst I've just shown you the Dixie on this chart, it's probably best to get the German one up, but we've called on all the major debt markets. This is why you've been getting euro strength. Again, I say it's strength, inverted commas, strength at the moment, because it is there's a lot of things that can happen and see you go up that is not actually a sign of health. We used to have, the analogy of, hey, if your currency is going up, it's because you're positively viewed. It's your share price for your country. What's actually happening is we're having movements in the debt markets that are likely to see the European debt go up. So we've called for Germany, that's actually normally at a 2.5, it's quite low risk of default percentage, to actually trade up. Now, during this tariff talk, it's actually come down quite a lot, but we expect this to reverse and return up. This was a beginning of a breakout candle. You get a return move. We would have stops here and we'd be long German, long the yields, short the debt. here, right the way up, and we're seeing it going, up to 4%. We see the same for French, only going to 4.6, and the Dutch debt, 10 years, all of them. Why? They're going to have to borrow even more. Never mind all the new immigrants they're getting that they have to pay welfare on. They're going to have to borrow even more to start accumulating military aspects so that they can punch their weight in terms of self-defense, given the whole Russia is bad narrative, which of course I don't agree with either, because you also asked about America, Ukraine, and all of that, and there was a sort of Biden, Russia bad, Trump, Russia not so bad vibe. This is how they just move different aspects of their agenda all along. It's a left foot, right foot, but they all belong to the same bird in terms of where it's walking. So we actually see yields going up on European debt, which is why you've had a little bit of cranky strength in the euro. Not because euro's in great shape and its prospects are magnificent, just because of interest rate dynamics for now. So you can see the euro USD, if we do that, has actually been pretty strong. It's kind of a bit like the inversion of the dollar index, but it's nice to see it in that manner. You can see, if I clear my face a little bit there and go back to the weekly chart, the euro's gone from about 1.02 to 113. It's quite a rapid increase. This is why I say you're going to start getting more higher volatility. There was a nice little setup in there. You can see it, and that points to a higher euro here. This was the setup. Let me just delete that draw tool for a second. I'm on the weekly time frame over there, and you can see that you've just gone, and gone. And this is dollar deval, selling dollar, buy gold. Buying gold is the biggest anti-dollar. Even if you're selling euros and you're in Europe, it's still an anti-dollar, because the king of the anti-fiats is gold and the king of the fiats is dollar. So even if you're getting rid of South African rands, Turkish lira to buy gold, you're also poking the dollar in the eye, because a long time ago people would have been happy to have had the dollars, and you're saying no, you're not the ultimate substitute. So debt is no longer a reserve asset. You're going to see higher rates, which is devaluation of debt in Europe. So they're just half a step behind America, that's already had a 50% collapse at its peak in terms of its debt markets. The Eurozone, as they start militarizing and overspending there, are certainly going to do it. And it'll come a lot quicker, because they don't have the same drawing rights as a hegemony. You have these different debt markets in different countries. The Italian 10-year is not going to look like the German 10-year, even though for now there's a proxy that Germany backs everything. Once they start looking like the tensions are building and they might break up, you're going to have all the problems that started the Greek crisis, Cyprus, etc., the Portugal, Italy and Spain. So those things where we were involved in calling the euro Swiss franc short in 2009, that foretold the pigs crisis of 2010. That was the name it was given. So my life of economic history is made up in trades, big macro trades. And this is the biggest of them all that we're witnessing. And gold is without doubt the best thing you can have right now. I'm not ready to go overweight the miners. I have some miners and I have some silver. Here's a controversial opinion I'll share with you as part of this, and I'll just bring this in. But I need to show one more chart before, and that is that people have pivoted too strong to silver too soon. Everybody goes, oh, I know this movie, and silver wins much more in the end, and they rush into silver. This is going to be a far larger extended cycle. So if we go to the gold-silver ratio, I was just mentioning it, we feel that in actual fact, gold-silver ratio is going to extend right the way into the 170s. And in a possible blow-off moment, because we typically get over performance, this is how you go up when you're in a blow-off moment. It's just like ridiculous amounts. All of a sudden, in 3 candles, we're on a fortnightly there, so that would be 6 weeks. You just shoot. You literally were 1 minute you're at 89, and then you're at 126. It's like, wow, how did that happen? 30, literally in 6 weeks, and that's just violent move. It's our opinion that not enough people You see, no one's really a macro technical analyst. No one makes these calls. It was the same for us when we called single digit oil and the turn in the bond markets. It's a crazy thing to say. It's the end of the bond cycle when we said it. Now it's commonly accepted wisdom. It was a crazy thing to say, single digit oil, and you should be going long gold, short oil when we said it. Because everybody was inflation trade, oil's going to go up, all of that sort of stuff. No, consumers getting wrecked and shutting everybody down. Very bad for oil price. We didn't know what was going to be the story. We just got the technical trade. That's why we're earlier than most people. And most people are not going to make this. And let me just be clear. There's going to be silver bulls. I'm a silver bull. Here I am. Where's my coin? It's somewhere here. And I am in silver, but I am stacking gold more aggressively. There's my silver. And I'm stacking because it's going to extend, in my opinion. Why? Because this is the biggest meltdown you've ever had. You've never seen it. Everybody thought shutting the world down is, how do you top that? This is a bigger crisis in terms of the financial aspects. We've seen that most times you got to 90, the silver ratio sold off. It's only in the big crisis you did that. This is the big crisis. And this is just starting, and gold is going to continue to outperform because the big players with the big money are going to keep stacking gold. They don't have the storage space, and they have hundreds of millions to hide. They have to buy way too much silver. And more importantly, the people that do this are the insider cartel, the banking cartel. And they want cheap silver a little bit longer for the military industrial complex that has 5 kilos of missile, for the Tesla battery cars so that they can surveillance finance you and check where you are and take over the car, auto drive it to the police station because you committed some social crime on Twitter, etc., etc. They need silver to be available for solar panels and everything else. You are in a suppressed silver market. It's a small enough market that can still be bullied a lot more, and the big money is going to chase gold. The big money is not going to chase silver. The retail money is going to chase silver, trying to jump to the next phase because they were late for gold. If they were following us, they weren't late for gold, and they should stay playing phase one until it's official that phase one is over. Phase one is over is when the gold-silver ratio reverses, and it's confirmed when it breaks 75 down to the downside. We are going in the opposite direction. You should continue to play what you see, and that is stacking gold. By the way, that doesn't mean I'm bearish silver. So the comments are going to say, oh, it's bearish silver. I don't like him anymore. I'm a silver stacker. It's affordable. Listen, gold's affordable. If you buy 1 gram, it's $100. If you can't afford $100, think about, what you're doing for income. That's a different problem, and we can talk about that separately. So gold should be bought now for the outperformance it offers. It's going to extend, in our best view, a lot higher. Then, once it turns, on my DCA, I go 100% silver. So if that's up here and we just run the 171 and we get that slam down like that, right here, I go from buying 75% gold, 25% silver to going 50-50. And when we break 75, I go 100% silver to the downside, which will be somewhere around here. So this is something that's really important. And to people that are hearing me say this, that we could stretch that far, let me just show why I say it as well, because it's going to be a difficult, and this is a unique view. There isn't a gold bug telling you this right now, that the gold-silver ratio could quite possibly take out the previous high, never mind going to 170 or 200. There's nobody. Everybody is, whale into silver, guys, whale into silver. Let's be clear. You have a major demand-destroying event, and it sells off. Silver sells off more than gold. So it could be on a correction. Gold could correct back down to 3,000 and silver could fall to 22. In, the whole world's ending another, what? And who knows what's coming? The point of the matter is you'll be better off. It has a lower beta in the downside, owning the yellow stuff. The time for silver will come, but it's the turbo juice. It's going to be a lot narrower and it's going to be much more violent. Don't try time that too much. Collect a little bit. That's why I have the 25%, because unobtainium may come. You might not get a chance to play the silver. It might get so wild in the financial things, they'll just stop all markets. and then it'll be gold, and then they'll set new pricing afterwards. You've got to be careful. So that's why I'm saying this. Have a look at this chart on the Dow Jones, Jesse. I've been showing this to a couple of people now because this is really important. Dow Jones divided by gold ounces. Do you think central banks have reduced volatility and added stability, or increased and turned essentially the last century into three big pump and dump schemes? That's a bit of a loaded question. I'm imagining most people know where I'm taking them here. They were introduced in 1913, roaring 20s straight away. What do? They turn the turbo juice up, smash down into a depression. You went that 18.6 ounces bought you a basket of the Dow down to 1.88. Then they wound up a major bull market and liquidity, which included the tail end of the Russian Revolution into the Second World War, all the way up into the swinging 60s, 28.47 ounces of gold you needed to make it to the Dow Jones basket of average. When it collapsed, 0.99, sub 1. 1 ounce of gold bought you more than what you needed for a full basket of Dow Jones stocks. That was peak gold, peak Volcker, where he upped the rates and cleared out all the debt that was raised during the 60s for the Vietnam War, when they were blowing holes in the jungle. Later, today, the BlackRock will be filling those holes and picking up the contract for it, like they are in Ukraine and everything else. But that's a different story. So peak gold and Volcker over here, you're going to have the downside of that. Only we went far higher in dot-com boom on ever more leverage. We went to 45 ounces to get one basket of the Dow Jones stocks. We have already started the correction. We had a correction 2009. 2009 on the 6-month candle, by the way. This goes a whole century, so it's a 6-month. Each candle is half a year of the Dow Jones being divided by gold. 2009 is literally one hammer. Literally, you're at 7 ounces. And then you went down to 5 for QE 1, 2, and 3. Gold had started to move. Quantitative easing, the early people said, oh, this smells like money proliferation and devaluation. I'll hold something that doesn't get smaller every time I look at it. And we then had a bit of a rally. We had the CV19 event, shooting star there at 22.45. That's as low as you went. It was 12. We are now back up and over. It's a perfect double top, by the way. And you are now in the spiller phase of a double top that ends for me, I think, at half or below. But you're certainly, in my best guess, high probability for going below 1. Ever bigger pumps lead to ever greater dumps. That was 0.99. You will overshoot emotionally. The leverage, the unwind is going to be the most thorough, that there is no fourth cycle. There is no bond market to create it. They go back to the beginning and we start again with CBDCs, UBI, lots of write-offs, lots of renegotiated pension deals. You must comply with social scores, etc. Take any medical interventions, and then if you do your push-ups, the chip in your arm will let you get so many tokens, and you can buy your once-a-month beef burger in between your locust food. That's kind of how I see that going, to have a little bit of fun with it. But as you can see from this is a huge dump, and it's a far bigger cycle than just COVID. COVID was this in the Dow Jones. That's it, CV19. That's the event in the greater scheme of things. It's one of a few things. 2009, 2011. These are almost blips on this big chart. Here's your big main story of what goes down and what happens and how it works for gold. And that is, if you go to 0.5, for example, from 12, that's a 24 times overperformance for gold relative to the Dow. That means if the Dow actually succeeded in staying where it is, which I don't believe, but I believe it re-rates, your gold would go up 24x from here. I don't think that happens. Some of your gains is in the Dow going down. So this is, you go short the Dow, long the gold, you get your multiple of 24x. If the Dow halves, which I think quite easily and could do more, that's still a 12 times on your gold price. And so you do it. And that depends whether we get 0.5. If you've got 0.25, that's another doubling again. That's 48 times. So who I can't answer that. We're talking about the future. How much lower you go below 1, I don't know. But my overall take is you've never had a gold market like this, and people will chase in too hard into silver too soon because they say, okay, I've seen this movie. It is bigger, longer. All these were part cycles. This is an end of the full cycle. This number 3 is the whole cycle end. That's it. These were sub-fractals within that, 3 fractals within it. You're in the final one. This is one full cycle, you start again. That's how I see this. So when I go back to the gold-silver ratio, I'm hoping it doesn't sound so cranky to be suggesting it. I was showing it to you over here. Hold on, that's platinum. I was showing it to you over there. But I'm even showing on smaller time frames, we're in an upside breakout here. And we were calling this. In other words, this is just overperformance gold to silver. Again, that's not me selling silver. Silver can go to $50. I'm bullish silver broadly, but I'm much more bullish gold first. Then I'll flip when the ratio turns. So silver can go to 50, which is still being bullish. I'm not a bear silver. Again, clarification. But if we go 170, gold is 170 times. Well, if it was 200, it would be 10K. It's about 8.5, 9,000, and silver can still have gone up quite well. But you're going to be crying as an overweight silver guy when gold is chronically overperformed. It's a bigger cycle. Each stage is going to take a lot longer. There's so much leverage that has to be unwound, and it's all got to squeeze in an ever-growing market cap. You can't just chuck it all into gold. I think there's quadrillions of debt. There's hundreds and hundreds of trillions to all fit into a 22 trillion market cap. It's not going to happen that quick. It's going to happen in stages, but you're going to get big, big advances. So that's my outlier thought that many people might not have. Gold hyperextends its winning run. That sees the gold-silver ratio shock everybody and feel cheated. Silver guys will feel cheated. They'll still have done okay, but not nearly as well initially. Then it turns. Yes, it happens. And then I think we get single digits on gold-silver ratio, because that's how violent the correction will be. When we do go on the bigger time frame and we look at this, I think there's a possibility. And the clock could be stopped at any point on the bigger time frames, Jesse. You could go all the way, right the way down to previous historics, and then you're talking 4 digits for silver. But remember, you can have both journeys, not one. Don't jump into the carriage that's going to be sitting at the railway station and just creeping forward slowly, a stopper that's stopping at every stop, when the fast train's coming in on the other one, and then you can jump onto silver once it becomes a fast train as well. Take 2 fast, big journeys rather than one. That's my message. So I'll leave people to digest that, because no one in the gold space, we've been a gold bull for a long time, and now there's a lot of gold bulls, and many of them have been there for a long time too. But that's a controversial statement that we've made. Stay gold for longer, bigger gold-silver ratio to stretch beyond the highs of CV19.
Yeah, well, I love hearing ideas outside of the norm, because you're right. When it comes to silver, you hear all the time the gold-silver ratio is so stretched historically, it must return to the mean. We're going to see silver outperform gold up ahead. And you, based on your technical analysis and what you're seeing, you're presenting a very compelling case that now is not the time for that to happen. So that's great. We're going to jump over to the Rumble platform in a moment here, because as you mentioned at the top of the show, there's certain things we can't talk about. We have to be careful talking about on YouTube. So guys, search Commodity Culture on Rumble to find the bonus content, our Banned on YouTube series. We're going to dive into some controversial topics. But for now, Francis, tell us about the Market Sniper. Anywhere else you want to direct people online who want to hear more and learn more about your work?
100%. 3 primary goals I have for everybody I serve. Help them build more wealth, help them preserve wealth, which is a slightly different thing, defend what you have, and within that, buy yourself more freedoms and optionalities for what is going to be a reset cycle of events. We discussed this, and we discussed mostly the trading and the positioning aspects. So that's the make money bit at the beginning, the top. Number one, on YouTube, and you can follow and see us. In there, we have a mini series you can book. It's totally free. You'll get our newsletter with that as well. Go and subscribe on the channel. Hit always. We are often throttled. We also cover crypto, so you can follow the Crypto Sniper, and there will be movements there. We're talking a lot about gold right now, but longer term, the statist chosen one tokens will do exceedingly well. And my goal is, I'm absolutely passionate about this. I've lived my whole life watching this economic system, reading this book, and we're getting to the juicy bit, where you've watched a long mini series with 15, 20 episodes, and now a whole bunch of action and all the plot lines are getting wrapped up in the last 2 episodes. That's where we are right now. This is a quickening. Do not take this lightly, what's going on. There's contagion coming. I expect, as I say, hedge funds, banks. And for that, you need defense and attack. There's going to be real opportunities. It sounds super doomer. There's going to be real opportunities to build life-changing wealth, not just for you, but also for your children. So that's what we're looking in our community. You can book a call and choose if you want to join after watching our YouTubes for a while, if you like what we're all about. But thank you for having me on the normal YouTube session, and I look forward to the non-YouTube session.
Yes, as do
we also have a Rumble channel, by the way. So, yeah.
Oh, great. Well, I'm going to put links in the description below to all of that, your YouTube channel, your Rumble channel, and the Market Sniper website for those who want to check it out. Francis, this has been a blast, and I'm looking forward to jumping over to Rumble and diving into some more controversial topics.
Thank you for having me.
And thank you for joining us today. This episode is brought to you by ARC Silver, Gold, Osmium, for all your precious metals needs and to take advantage of their special right now, which are Silver Kangaroos 2023 1-ounce coins, mint fresh at only $2.47 over spot. Be sure to reach out to owner of ARC SGO, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.